So welcome everybody. Thanks for being here and welcome to this guest talk. Our guest today is Tony Lent, co-founder of Capital for Climate, which is an organization aiming to build a premier data-driven investment platform for driving capital towards impactful climate solutions. And Tony has 27 years experience as a principal investor and financial advisor in renewable energy and sustainable real assets. He has managed and participated in more than $2 billion of investments in sectors including low carbon infrastructure, renewable energy, nature-based solutions, agricultural transition, zero carbon fuels, green chemistry, and emerging markets financial services. I'm super excited to hear more, and I'm looking forward to digging into these topics with Tony. Before we start, in a moment, I'll just share a link in the chat of our Slido site where we can where you can add questions, and we'll collate those for the second part of the session. That's probably enough from me. I won't say more. Tony, it's a pleasure to have you with us, and thank you again for being here. Over to you.
Well, listen, thanks so much. I'm really excited to talk to you today. And just by way of background, this is the first time I've gone through this particular talk. So I'll be curious to see how it goes and also what kind of questions you might have as we go through it. I designed the talk for about roughly half an hour and for lots of Q&A. So I'm hoping that what I present will be intriguing enough to actually generate some questions. You've gotten a little bit of my background. I'm going to give you a little bit more. The structure of my talk today follows this roadmap. I'm going to talk about the climate finance gap to start and put it in the context of global capital. Then I'm going to give you a brief top-down view of what is effectively right now a movement of capital mobilization towards net zero. Then I'm going to spend time on a bottom-up view looking at the innovation economy, cleantech, and the accelerator economy. Then I'm going to talk and switch the conversation more to leverage points around climate finance. We're going to talk a little bit about renewables finance. We're going to talk about industrial emissions and nature-based solutions, specifically low-carbon cement and the capital flow to nature-based solutions. And then I'll have a couple of concluding remarks and we'll open it up for Q&A. So a little bit more about my background. So I didn't come to finance on purpose. I originally was going to be a conservation biologist. My undergraduate degree was in biology, tropical ecology, molecular biology. I was really interested in seeing how I could basically enter the field of conservation. I discovered that I wasn't really interested in being a research biologist, and I wasn't really patient enough to do molecular biology. I spent a couple years thinking about doing the sociology of knowledge because I was really interested in social movements. And then I kind of backed into an MBA thinking, if I got an MBA, at least I wouldn't go broke. You know, I'd be able to put food on the table. And while I got my MBA, I did that in technology management. And so after getting an MBA in technology management and combining that with a background really focused on conservation, I went up spending the next 30 years building businesses around environment and climate. So the main point is you can find your way into climate in pretty unconventional, climate and finance in pretty unconventional ways. Over the last 20 years, I've done a lot of things, as you heard, but one of the last businesses I started was a business called Swift Current Energy, and I helped co-found and build one of the largest renewable energy developers in the United States. As I was in the middle of building that, I noticed something happening around me, which was the genesis for the next company that I started, which was, on the one hand, there was this phenomenal amount of research being produced on a decarbonization roadmap. So you had Drawdown, you had Exponential Roadmap, you had BCG, you had others, and they were all really pointing out how we could get to zero emissions and roughly what it was going to cost. So this was unusual because we hadn't seen that quality of research in about 25 years. On the other hand, when I'll talk about this in a couple of minutes, we had the beginnings of large financial institutions making significant commitments to climate. And I thought to myself, well, if we've got capital lining up on the one hand and we've got roadmaps on the other, Wouldn't it be great if we could find a way to provide large-scale investors that were interested in climate with all the pathway work they needed and really clear guidance on what the leverage points were for climate? And that led me to the work I'm doing now, which is building out Capital for Climate, a guidance system for large-scale investors to navigate through net zero. So what is this all about? What's the really big picture here around climate finance? So just to put this in perspective, the whole planet has around 431 trillion worth of wealth. That's an incredibly vast amount of money. And what's really interesting about it is this amount of wealth has been growing really fast over the last 25 years. We are in the new Gilded Age, and that number, 431, goes up by around 8 or 9% per year right now. So it's massive wealth accumulation happening faster than economic growth. At the same time, global capital or global institutional capital has already committed 130 trillion to net zero. And I'll talk about that in a second. Just to put that in perspective, that's more than half of all professionally managed capital on the planet. And finally, the gap, the amount of capital that needs to go into climate is $4 to $5 trillion a year. That's also a huge amount of money, but it's only 1% of global wealth. So we know we can do it, and we've done this kind of capital mobilization before. So how do we know this? How do we know this is what it costs? And how accurate are these assessments? Well, they're pretty accurate. This is a quick snapshot of some of the major work that's gone on in the last 4 years to gauge the climate finance gap. Some of the most rigorous work has been done by the Climate Policy Institute in San Francisco, Boston Consulting Group, Climate Works, also in San Francisco, and McKinsey. All these assessments converge to roughly 125 trillion that's needed by 2050. It's a gargantuan amount of money, but if you break it up into a yearly amount, it's manageable. And by comparison, we've already allocated 24 trillion just to the COVID rescue over the last 24 months. And we've done things like this before. So if you look at the mobilization of capital in World War II in the United States, we were able to pivot our entire economy, more than 50% of our production capacity over the war effort in less than 36 months. So we have precedents. We can do this kind of capital mobilization. What's it look like right now? So today, there's already a lot of capital flowing into this area. When I talk to most people about it and I ask them, what do you think the amount is? If I'm in a conversation, even with people that work in finance, and I ask them to guess, is it $10 billion a year going to climate? Is it 50? Is it 100? Is it 500 billion? Most people guess between 10 and 100 billion dollars a year. In fact, it's in excess of 632 billion a year. It's probably closer to 800 billion, and it's growing at 12 to 15% per year. So we're definitely funding into the gap. We're not quite there yet, but it's growing really quickly. One thing about that that's really interesting, though, is that most of the capital that's flowing into the climate crisis is flowing into renewable energy, which we know pretty well, and to transport. And that's cool, right? But it's not enough. But critically, climate finance is already really part of mainstream finance. Just want to comment briefly on one element of finance innovation. I said that the capital flows were around 632 billion based on Climate Policy Institute, but this is a snapshot just of the sustainable bond and green bond market. So this adds to that amount, and this particular part of capital markets is also growing really fast. And it's quite likely that it will become a really significant contributor to filling in that capital gap over time as this market expands really quickly. So I mentioned that we're allocating most of the capital that's flowing into climate into just two things, one of which is renewable energy, and the other is the transportation solution section. What's interesting is this graph on the right. So this graph comes from a study that was done 3 years ago called the Exponential Roadmap. And it's a simplified view of what decarbonization needs to look like in the real world in order to actually achieve a 1.5 degree outcome. And you can see a couple of things here that are really interesting. Number one, where we're putting most of the capital is at the top part of the rainbow. So we're investing and planning to invest around 60 trillion there over the next 20 years. And the next part of the rainbow, which is mobility, doesn't even show it here. And what's interesting is industrial emissions, the built environment, food, nature-based sources, and nature-based sinks are actually the majority of emissions reductions opportunities. But today, we're actually not allocating capital into those parts of the decarbonization roadmap in anything near a ratable way. So we're not investing proportionally. And what's really critical to understand is if we don't actually allocate capital to those other parts of this rainbow graph, we don't achieve 1.5 degrees. So it's really important, and I'll talk about this a couple of times, to focus in on these other pathways and also to invest in the leverage points within those pathways. So what's going on in global capital markets? Who's actually working on this? Is there anything happening? Are people actually mobilized? And I want to say something that is going to probably potentially sound surprising to the class here, and that is that there's actually a movement going on within the mainstream finance community, within the largest financial institutions in the world. Over the last 5 years, there's been really what I would call almost a revolution in thinking about how large-scale capital is relating to climate. And this is just a snapshot of 5 of the most important groups that are part of this transition. And it started with 2 key elements, one of which was the Principles of Responsible Investment, and the other was the Carbon Disclosure Project. And this has led to the formation of 3 really critical groups: the Institutional Investors Group on Climate Change, the Net Zero Asset Owner Alliance, and then ultimately the Glasgow Financial Alliance for Net Zero, which was formed at COP26 just this fall. To put it in perspective, to back up for a second, these groups, as I said before, represent 130 trillion that's committed to net zero. And when we started working on Capital for Climate, which was the summer of 2019, we first gathered up a group of investors in a room at GCAS, which is one of the key meetings on climate, in September in New York. And when we did that just 3 years ago, the total amount of capital that was actually aligned on climate or even engaged on climate was around 40 trillion. So that amount has more than tripled in the last 3 years. And that's a really huge change. And I would say, and frankly, it's kind of a revolution in finance. I just want to draw your attention really quickly to one quick point here, which is what it's going to cost. And I'm going to come back to this again a couple of times in the presentation. But the transition in power is estimated to cost around 60 trillion over to 2050. In cement, tiny amount, 1.5 trillion. That'll become important later. In agriculture, 1.9 trillion, tiny amount. That's going to become important later. And in transportation, 40 trillion. So you see the 2 biggest elements of the transition are repowering the power sector and ground transportation. So primarily the cars, trains, buses. So where are people? Where is the global finance in its transition to net zero? Well, there are 4 elements of what large financial institutions are doing so far today. And they come down to these 4. 1, corporate engagement. So large financial institutions basically engaging with the corporations that they own pieces and parts of, and having those corporations commit to net zero and come up with implementation plans to reach net zero. The second is figuring out ways to measure their scope 1, 2, and 3 emissions across their own portfolios. And that spawned an entire industry of technology companies and fintech players and measurement technology to help large financial institutions figure out what their financed emissions were. And then thirdly, and this is probably where most of the effort's gone over the last 10 years, is assessing their physical climate risks in their portfolio. What does that mean? It's really downside measurement, trying to understand what is it going to cost them and cost their portfolio if they get bad heat waves, massive storms, terrible tornadoes, hurricanes, rising seas, fires we've seen, drought, or worse, crop losses, famine, conflict. What's interesting from our perspective is that actually allocating capital to climate solutions is just coming up on their radar as something that they can think about as a way of converting their net zero commitments into effective allocation to address the climate crisis. I don't know about you, but I find that kind of fascinating, that it's right now it's still last on the list. So I've just spent a couple of minutes talking about what large financial institutions and what giant capital markets are doing. So think about that as the top-down view. Now I want to spend a little bit of time talking about the bottom-up view of climate finance. So whereas capital markets tend to move really slowly, as you know, things tend to happen pretty quickly within the venture and innovation community. So I want to just draw your attention to one interesting thing that really surprised me, at least over the last couple of years. That is how effective the accelerator and incubator system has been in really focusing entrepreneurs and capital on the most important lever points within climate. As you probably know, like the accelerator ecosystem got born around 10 or 15 years ago. Groups like Techstars and Y Combinator and SOSV were really important in kind of building up the beginnings of this financing ecosystem, which really initially was just focused on filling a gap that existed in early stage investing around primarily the United States and to some extent Europe. What's amazing is this technology, or this system, call it the accelerator system, has now been levered and kind of hijacked by the climate community to develop a whole range of incubators that are focused on very specific parts of the climate crisis. And I just want to focus on a couple of here that I think have been really effective, because I think they've done a great job of priming the market with technology that didn't exist a couple of years ago. So this Elemental Accelerator on the West Coast, founded in 2009, they've already built out and funded eight low carbon unicorns. Prime Coalition up in Boston, an incubator totally focused on finding hard technology companies, each one of which they underwrite to a 1 gigaton hurdle. Third Derivative, which was just started by Rocky Mountain Institute about 2 years ago, which is focused on actually trying to innovate the entire acceleration system and bring the whole value chain, the entire capital community to bear around innovation. So those are kind of structural examples. And now I want to talk about some that are focused on very specific narrow gaps, because I think what's really exciting about the incubation and the accelerator system is its ability to focus. I think if you look at all of them together, and one of the most effective ones that we've seen so far was the Global Cooling Prize that was launched by both the air conditioning industry and facilitated by Rocky Mountain Institute. And what they did was they focused the entire industry on coming up with, and through a prize system, soliciting designs for air conditioners that could be 80% more efficient in just one generation. Why is that important? Because air conditioning demand is set to be 26% of all electricity demand by 2040. And to date, most air conditioning product cycles were only getting 3% efficiency per generation. So it's a huge contribution to the field. Others are the Carbon X Prize, which is focused on carbon removal. And then most recently, what we've begun to see, and this will be relevant as I round the talk up, is we've started to see the beginnings of accelerators just focused on some of the gaps around nature-based solutions and nature and carbon. So after you've built out your seed stage companies, and you've got them going, and they've got the beginnings of some either pilots or initial revenue, the next thing that happens is you generally wind up seeing these companies funded by climate tech. I got to say, I've never seen anything like the boom the climate tech community has gone through over the last 5 years. Throughout the course of my career, I've seen a couple of different boom and bust cycles for what was originally called cleantech, and now it's called climate tech. I got to say that after the 2008 financial crisis, and I was investing through that, climate tech was basically dead until 2015, 2016. You couldn't get capital for anything that was related to climate. But between 2016 and today, we've seen roughly a 5x increase in the amount of funding available and the amount of funds that are active in the space. There are already more than 200 pure play climate tech, or mostly climate tech funds around the world today. The number's growing. And what's really also pretty exciting to see is that growth equity is also already filling out. There's more than 20 large or large-ish private equity funds investing in climate that have been raised specifically for climate that have more than $2 billion under management. And I got to tell you, I couldn't have imagined that happening even 5 years ago. And what's amazing is that the industry has really, truly become global. So this is true for all of venture capital and all of private equity, but it's also really interestingly true for climate as well. And what I find astonishing is the valuations. Now, obviously, we're kind of in the middle of what could be argued to be a bubble, but still, take a look at these valuations in the middle, the lower part of this slide. We're looking at total valuations for climate tech ventures approaching $1 trillion. To put that in perspective, I mean, the US economy is only around 24, 25 trillion. So it's a lot of valuation. And we've seen 47 unicorns built since 2015. What's interesting about that, and I think this is really important both in terms of the sociology or the culture around investing in climate, is doing two things. One, it's making all entrepreneurs understand that they can become wealthy and quite successful working on the climate crisis, which is important. I mean, never underestimate the power of greed to get people motivated. And secondly, it's creating an entire class of billionaires that have made all their money from climate. Not, if you even excluding Elon Musk, there are more than 10 climate billionaires now around the world. So let's change our focus now from getting rich to actually thinking back again about, like, what would you do if you actually wanted to solve the problem with capital? So I just want to talk a little bit about the electricity transition. So renewable energies represents around 35% of emissions reduction to 2050. And one of the things that I understand about this class, and I've heard a couple of times from Seth and David, is that a lot of people that are listening to my talk today are thinking about where they're going to work or how they're going to transition into climate. So I wanted to make sure I touched on the renewable energy revolution because it's important. But one of the things that's interesting about it is it's really well proven right now. We're putting around $400 billion a year into renewable energy. It's a global industry. The investment template is extremely well known. The core technologies are proven. Growth is actually predictable for decades to come. In fact, in order to be successful in achieving 1.5 degrees, we have to increase the rate of investment in renewables by about 500% over the next couple of years. The development path is really well understood, and the primary barriers to taking renewables all over the world even quicker are just two things: long duration storage and better grid management. And those are two really eminently solvable problems. Costs have been reduced really quickly. They're going to continue to drop. So what I would say to the people that are thinking about what they're going to do with their careers is there's tons of jobs in this space. It's a relatively easy place to do really well. In some ways, though, I would tell you it's not the most exciting place to be. Some of the other areas that look more boring are actually in some ways much more exciting. So I want you to think back to that rainbow slide I showed you earlier in the presentation, those different pieces of the emissions opportunity or the emissions reduction opportunity, and look at this graph on the lower left-hand side of this slide for a second. So these are industrial emissions. And what I can tell you about industrial emissions is industrial emissions right now are attracting almost no capital. That's really interesting because if you take it one of the largest sources of industrial emissions, which is cement alone generates 7% of all global carbon. I just want to talk about that for a second as it compares to, say, the global energy industry, which is many, many trillions of dollars of market cap. The entire cement industry globally probably has an equity value of less than $100 billion. The three largest producers, which you see here on the left, are three of the largest global producers of cement, have a market cap of less than $50 billion. Why is that important? The reason that's important is you see that little number on the left here, 2.52 gigatons per year. That's how much carbon dioxide the cement industry produces every year. And we know, based on what's going on with COP and the global move towards emissions regulation and legislation, is it extremely likely that all those emissions are going to come under some type of carbon regulation over the next 5 to 10 years. What would happen if it did? So if the value of emissions reductions was valued at $50 a ton for cement, the cost every year for the cement industry would be $125 billion a year, which is more than the equity value of the industry itself. And because of that, you know one thing for sure, which is the cement industry is under incredibly high pressure to change. But what's also important to understand about it is that it's a really old, relatively conservative industry. There hasn't been a lot of innovation around building cement in about 100 years. And what you usually find is in large material-based old industries, R&D spending is almost nothing. And so you're not likely to see the innovation the cement industry needs coming from the cement industry itself. And you can see that in some of the not so awesome or not so aggressive targets that the industry is setting for itself by 2030. Cemex thinks they can achieve 40% emissions reductions by 2030, Heidelberg 33 by 2030, Lafarge 20% emissions reductions by 2030. Now let's look at the disruption economy for a second. There are more than 30 companies that have been started that are just focused on low carbon cement or low carbon concrete. Here are 4 of the more interesting ones that have been founded in the last 5 years. Look at the numbers they're putting up in terms of the product they're producing and putting into the market over the next 2 years. Material evolution, 85% less carbon dioxide in their cement. Ultra high materials, 70 to 90% less carbon dioxide in their cement. Solidia, 40% less carbon dioxide in their cement. And Brimstone, recently founded, is claiming basically carbon neutral cement or zero carbon cement. Why is this important? Because if you look at the cost of funding all those companies to date, all 4 of those companies have absorbed in total less than $150 million. And they're holding out the promise for the whole industry. Are these groups talking to each other right now? Not yet, but they certainly will be shortly. So I think my main point here is there are lots of places where finance can play a really high leverage role in emissions reductions, and there are also lots of places in the emissions reductions roadmaps that are not overcrowded and have a lot of opportunity. I want to talk now about a second major leverage point, and that's nature itself. If you recall that big graph I put up from the Boston Consulting Group SIFMA study, what you saw on the bottom right-hand side of that graph was $126 trillion to 2050. What you also saw in that graph, if you remember, was 1.6 trillion for agriculture. Well, what's interesting is that nature-based solutions themselves, according to the best research in the world from TNC, McKinsey, Exponential Roadmap, the Potsdam Institute, and many other scientific researchers, is that you can achieve more than 30% of emissions reductions for the entire planet with nature-based solutions. We're talking about forestry, conservation, coastal ecosystems, blue economy, regenerative agriculture. And what's interesting and really profoundly, I think, positive is that if you look at the total cost of the transition in nature-based solutions, it's only $10 trillion to 2050. And it can capture 30% of emissions reductions, and probably most importantly, it does emissions absorption. Like if you look at all the other things I talked about today, they're all about mitigation. We're talking here about emissions absorption. Right now, we're not moving very quickly on this, but it's one of the most promising areas in climate finance. What's happening to date? Well, this gives you a sense of where we are from the mobilization perspective. And what you see here is indicative, I think, of just the general relationship between private capital and public capital in these areas. You can see some of the public capital commitments that we've captured over the last couple of months. And you can see on the right-hand side, the private capital commitments we've captured over the last couple of months. And you can see that private capital is getting mobilized. These are some of the most important deals that have happened around the planet. The HSBC, one of the largest banks in the world, forms a joint venture with Pollination to build a natural capital investment manager with $3 billion. Hartree Partners gets formed. Really interesting backstory on that, to put $2 billion into the voluntary carbon market around nature-based solutions. AXA, one of the largest insurance companies in the world, does a joint venture with Engie to put $500 million into agroforestry over the next couple of years. I got to tell you, that's astonishing to me. New Forest raised $120 million in a first close for their Sustainable Forestry Fund in tropical Asia. Kimmeridge puts $200 million into nature-based carbon offsets. And then just yesterday, we saw across the carbon finance news that Climeco raised $50 million to expand their reforestation business. We're seeing a ton of activity in the nature-based startup market, which I would have, in my wildest dreams, never imagined was even possible 10 years ago. So I would say the nature-based investment area is overall one of the most promising. I would also say it's also one of the least well-defined and kind of the wild west of climate finance in some ways. So for people that are interested in jumping into a part of the business that has a lot of opportunity and is not already well-defined, this is it. And so one of the things that we were asked to do as part of being Capital for Climate is we teamed up with the high-level champions team that was organizing COP26, and we built for them a nature-based solutions investment platform, which we can send over the email address for later, which was designed to really help large-scale institutional investors understand what it was all about, what it meant, what the leverage points were, what the background was, what the funds and vehicles were that they could invest in, and what the key initiatives were all around the world that would help them put money to work. It's a good primer if you're interested in learning about the space. So what have we talked about just now? Let me just get to my concluding remarks here. Hold on a second. Apologize for the delay. I think 4 main things. 1, addressing the climate crisis is going to require a huge mobilization of capital. But I just want to make the point, it's a mobilization of capital that's manageable. It's a big amount of money, but at the end of the day, it's probably not going to cost as much money as we thought. 2, there's a huge movement underway in mainstream finance to commit to net zero and ultimately to convert those commitments into effective allocation. But so far today, the allocation is kind of ad hoc and it's not quite as effective as we'd like to see it. There are really outstanding decarbonization roadmaps that show us exactly where we need to put that capital. But to be effective and to go fast, everybody involved in climate finance needs to really focus not just on those roadmaps, but on the lever points within those roadmaps to be successful. And that concludes my remarks, or my formal remarks, and happy to take any questions you might have.
Excellent. Thanks so much, Tony. A really powerful whirlwind tour of what's going on, and some really interesting insights there as well. A first very quick question is whether you'd be happy to share your slides with us for anyone that wants to sort of
yeah, of course,
revisit them. Yeah, okay, that's great. So I'll kick off with a couple of questions. There's some great ones already in Slido, and I've put the link in the chat there if folks want to add more. But you can also look through the questions in there and upvote them if someone's already written what you want to ask. I wanted to run right back to the beginning of the talk, Tony. You mentioned how much finance is currently flowing, and compared it to sort of that level that people are estimating is needed. And of course, this was mentioned in the IPCC report that came out just this Monday about that finance gap that still exists, and kind of that stark reminder of the fact we're still a long way off the path that we need to be on, despite the progress we've made. So I just wondered if there's been any reaction in the kind of investment community to that report on Monday and to that highlighting of that gap still. Are there conversations going on about this?
Well, I want to say, let me say 3 things about it. Number 1, while the finance community is extremely engaged on climate, they don't view the gap itself as their responsibility. When large-scale financial institutions look at climate, they look at it from the perspective of risk and return. Where can I put my capital right now in order to make a risk-adjusted return that makes sense for me? I think they will get to the point, and some institutions, primarily outside of the United States, do view it as part of their kind of social responsibility to be thinking about and financing into the gap, but most do not. My second point about the gap is the gap is nowhere near as important as finance innovation and the mobilization that we can do right now. So things like scaling up renewable energy, accelerating the transition in EVs, focusing capital on those leverage points is really going to be super important, because we're never going to have I can say this with absolute certainty, we are never going to have a perfect system of finance to address the climate problem. Everything that we have as in the way of tools is going to be not good enough, and the finance market is going to be imperfect, and we're still going to have to succeed at this mobilization. So I would just caution people to expect perfection in the work.
Yeah, thanks, Tony. And that in some ways leads on to my second question, and it's been touched on in the Slido by a couple of people as well, which is a little, maybe slightly more political, but it's about how much the finance piece can solve the problem, and where it can't solve the problem, and if it recognizes that. So I'm always thinking about this, and I still haven't figured out my overarching thesis about solving the climate problem. But at Terra, we always talk about a big tent approach that says yes and to as many meaningful solutions as possible. But one of the challenges that I come across is that not all the solutions that we need to work on will necessarily be something that will give you a return on investment. That's my worry. And so, do you agree with this? Do you ever spend time thinking about those non-investable challenges and solutions, or do you think there's a potential for everything to have an investable, financiable tool to make it work out in this context?
Well, I don't think that everything has a high financial return. But what I say to people that are, when I talk to institutions, or particularly when I talk to ultra high net worth family offices, what I say to them is the following. We know with a great deal of certainty that most things that we invest in with relationship to climate, even if they're not yet fully bolted down, so like looking at like the ecosystem services payments for coral reef conservation, or looking at something like making small and medium-sized farmers more sustainable in emerging markets. Even those part of climate solutions generate a positive return. Is that return going to be 3, 5, 6, 7%? I don't know. But I know that by investing in it, I'm going to make a positive return. And there's lots of the landscape of climate finance that delivers an outstanding return that's highly predictable. So the whole renewable energy industry has already become the largest single section of infrastructure investing worldwide. So what that leads me to is the following kind of mental equation, particularly as it relates to both public and private finance, which is, we know if we invest now, we will make a positive rate of return. But we also know if we do not invest aggressively over the next 20 years, there's almost no amount of capital that will solve the problem that we create. And so I try to put it in that perspective to them. But on the second kind of embedded part of your question, I think that governments are moving far too slowly in capital mobilization for climate. I think it's unconscionable how slowly they're moving. They should be matching the private sector and or in front of the private sector. But for a host of historical reasons, that's not happening yet. And so one of the reasons I'm actually pretty excited about the capital movement within private markets is there's at least some political leadership within private capital markets on climate, which I think is making governments feel a little embarrassed.
Yeah, thanks. And I noticed that part of that slide in your talk as well, which was quite interesting. So yeah, thank you for that. Just before I go on off this topic, there was one other question in the Slido which I thought spoke to this quite well. So I'm just going to see if I can find it again. Do you think the logic of capitalism, by which we mean kind of growth and investment, and then that return on investment and further growth and so on, can steer us out of the climate crisis without any change in its kind of structural mechanisms, or is it always going to hold us back because it's actually the thing that's sort of driven us into this place where we've pursued profit over what other metrics which might be more beneficial to our well-being?
I think that we're already seeing a massive shift in capitalism, particularly in the West and particularly in Northern Europe, around what capitalism is supposed to do, who's it for, and what is its higher purpose. I think about it a lot. I actually think that's on a really good trajectory, but it's on the whole, rebuilding and redesigning capitalism itself is probably on a 75-year trajectory or a 100-year trajectory, a little bit like, it took 100 years to end slavery. We don't really have that much time on the climate crisis, so which is why I think that we need to make do with what we have. But I don't think that we're going to have to completely, I don't think we have to completely redesign capitalism to put it to good use, which is why I put that slide up on the green bond market. The green bond market could expand to multi-trillions every year. And frankly, what it should be is it should be connected up to the global savings market, because we have a massive savings deficit worldwide, and that would be a nice pairing of social benefit with climate outcome. I do also agree that there has to be around the world behavior changes, but I think we're already seeing that, and you're seeing it in two ways that I think are really telling. One is we're seeing a revolution in protein production, where a whole cohort of humanity called Gen Z and millennials are starting to look for and seek out alternative proteins, and they're not just doing it because they care about the environment, they're doing it for other reasons around health and animal welfare. And you're seeing the beginnings of the same thing in the EV market, where it looks like you will see a significant shift to EVs around the world, which is a behavior change. There are other behavior changes we need, but we are starting to see the ones that are going to be pivotal in the transition. So I'm pretty optimistic about that.
Great. Yeah, thanks, Tony. You just mentioned bonds, so I'm going to jump onto this question, which maybe if it helps to bring the slides back up again, we can do that. But I'm wondering if you can dig in a little bit more to explain what green or sustainable bonds are, and where they come from, who's kind of managing them. And slightly related, there was another question about, let me just find it, which was, are they for, I don't understand this question myself, but you will do. Are they for retail or institutional investors? What maybe you can help define what that means.
That is a great question. So I love the sustainable bond story and the green bond story because it's a story about activism. So I have three friends that were actually instrumental in building the green bond industry. One's a guy named Mike Eckhart, and the other is a woman named Camilla Seth, and the third is a guy named Sean Kidney. So Mike Eckhart was an early pioneer in the renewables business, and when I was first starting a company called US Renewables Group, which was going to become one of the first large institutional private equity funds in renewables, Mike Eckhart sent me a 5-page white paper called Principles for Green Bonds. And it was like 2004. And somehow that thing wound up getting into the mix and wound up on the desk of a friend of mine at JP Morgan, who wound up, this is Camilla, and they wound up funding a guy named Sean Kidney, who set up something called the Climate Bonds Initiative. And they basically, working with the World Bank and other multilateral banks to start with, they actually seeded the development of the green bond industry starting in I want to say 2009 or 2010, initially with offerings from the sovereigns, like I said, sovereigns and multilaterals. That's grown over time into this gigantic financing machine, which funds both climate, social issues, social equity, and sustainability topics around the world. And it's been growing at a really fast pace. And as I said before, I wouldn't be at all surprised if it's a $5 trillion industry in the next, or $5 trillion of issuance in the next 10 years. You asked a great question, though, which is, are they available to retail investors? And the answer is really hard to get at through the retail market, but I think that's going to change in the next 3 to 4 years. And what you'll see is, you'll see places like, Fidelity and Wealthfront and all the major providers will have some ability to access the green credit market. And if you're moderately high net worth, and you sort of are a quote unquote accredited investor, you can pick up other green credit products through your financial advisor.
Thanks, Tony. And just to make sure, because I'm pretty sure I understand this, but in case anyone else doesn't, or in case I'm getting it wrong, the term bond means essentially a loan to carry out the project, and then you get regular returns until you've paid off the loan, right?
Yeah, I
That's
think of a bond as like the simple, and this may not be the right technical definition, but I think of a bond as a traded debt product. So instead of it's a traded loan. Like when you use that, and it also is from a technical perspective, it often has lighter requirements than a more traditional bank loan from the perspective of the issuer.
Yeah, got it. Thanks for that. I think throughout your talk, you kind of covered how energy and power, and then sort of mobility and transport are the two booming sectors of climate-related investment. And then there's all sorts of other areas which are underfunded at the moment, or kind of underhyped. And someone was just asking if there's any areas that you see as overhyped or kind of overfunded. Presumably the answer is no, we still need more of everything, but I just wonder if that sparks any thoughts.
Yeah, I think there's a lot of areas that are overfunded actually. To give you a perfect example of one overfunding event, if you look back to the cleantech market crash, which is around 2009, 2010, it's really driven by the fact that in that particular boom, 90% of all capital was invested in solar technology at a time when China already dominated the PV industry, but people hadn't really woken up to that fact. I think in this particular wave, one area that I really find surprisingly overfunded is ESG analytics, and this is in the venture side, and the other is climate risk analytics. There are probably 50 startup companies that have attracted venture capital to answer one question, which is, what is my climate risk? And I personally find that kind of ironic or funny, because you just have to read an IPCC report in the last 9 months to know what your climate risk is.
Yeah, good point there. I guess this isn't in the slide, or at least I haven't seen it yet, but I wanted to pick up on the nature-based solution piece that you talked about, and how it fits in with the various critiques that often surface around paying to offset your carbon by buying a piece of forest, and potentially the people that then protect the forest are kicking off native or indigenous people from using the land, or planting new trees that are sort of like monocrop plantations and not good for biodiversity. Obviously, those are really specific bad examples, but how do you navigate the nature-based solutions piece with these kind of critiques surfacing quite frequently about how including how difficult it is to measure carbon sequestration in nature-based solutions, and how potentially unstable they can be, all of these things that come out. How do you think through those?
Well, let me start with the technical side of the question, because I think that's really important, which is I think that within the measurement community, measuring carbon is also right now an area of intense venture capital investment. And I don't think that I would be willing to bet there's not a single part of carbon measurement which isn't completely bedded down over the next maybe 48 months. And by that, there isn't a good solution for it. And we already see it. You've got this really good above ground carbon measurement, or pretty good above ground carbon measurement. There's some questions around below ground carbon measurement, and there's a lot of questions around offshore carbon measurement and coastal carbon measurement. But those all have technology solutions chasing them. So I'm not worried about the quality of the measurement. I'm also not worried about the quality of the carbon market itself, because I think that you're already seeing within the carbon market a lot of self-regulation around what's called integrity. And the market, interestingly driven by the tech companies, is already pivoting towards high integrity, long duration carbon. That's playing out primarily driven by companies like Netflix and Microsoft and others. And I think that'll ripple through the world. So you'll have kind of a bifurcated market. You'll have really high integrity carbon, and then you'll have just so carbon. But I think there'll be a price premium for high integrity carbon, and that will drive investment in high quality nature-based solutions. To your other question, which I think is a really interesting one around offsets, I gotta be honest and say I have a little trouble with the another part of that question, which is around the notion of additionality. You look right now at the total cost of stopping deforestation. It's de minimis. You could probably stop deforestation around the world for like 200 billion a year, or maybe 100 billion a year max. And many people would tell you that that investment would not be additional because of something. It's hard to prove that it was additional. But the fact is, it's a super low cost investment that would conserve our most important carbon stocks. And yet this whole notion, the whole narrative around additionality makes certain kinds of conservation investment and forest protection investment more challenging than it ought to be.
Yeah, thanks for that, Tony. So I'm conscious we've got just over 5 minutes left. So thanks everyone. There's far more questions that we're going to be able to cover, but I'll see if I can pick some of the most popular ones from Slido. So someone was asking about why was clean tech so unpopular for investors for some time. You talked about, shortly after the financial crash in 2008. Did the investment community not expect climate change to, eventually come back onto the table, or was it, what were the reasons behind that?
I think there were two really important reasons behind it. One of them was narrative frame. I don't really love narrative frame arguments, but I think in this case it really applies. So the first wave of investment was all framed up under what was called cleantech. And I got to tell you, most investors didn't really care about cleantech. It just wasn't that important to them. So over that next 12-year period, I think most investors most investors at large institutions that are sophisticated that make these kind of investments have realized, oh yeah, this is really real. And this entire train of investments relates to solving one of the biggest problems we've got. So it's kind of a more compelling investment narrative this time, and I think that's what's helping to spur the increase and ramp in capital, particularly on the innovation economy side, which I think a lot of certain kinds of investors are super excited about. But that doesn't get to the second part of your question, which is why was there a capital drought? And the answer to that question is also really important, which is when investors get burned on a sector, they leave it for a long time. And so when people got burned on clean tech, I think notice it didn't come back as clean tech. It came back as something else called climate tech. And I think that was part of the reason. And secondly, investors hate it when an entire class of an investment falls apart. People can lose their jobs when they make an investment in a sector like that, or they think they can lose their jobs, and so they don't want to go near it.
Right. So again, forgive my naivety here, but what was it about the clean tech sector that that investors felt burned by as a result of the obviously global financial crash of 2007, 2008? What makes that stand out as one for them to have steered clear of at the time?
I think that the financial crisis just happened to happen at the same time as the clean tech bubble broke. So I wouldn't link those in your mind. I think the real issue was, if you looked at the funds that were formed at that time and the kinds of things that they invested in, and you just look at their portfolio constructions, they had way too much weighting to solar. Most of them had way too much weighting to solar. And a lot of the solar technology people were investing in was super exotic. And so as a result, you had things like, and I did some of this investing, so I felt it personally. We invested in things like concentrated solar, or we invested in things like solar thermal, or we invested in super advanced panel technology. And what we all thought was going to happen at the time, and this was the consensus, what was the wrong consensus, was when we were making this investment, or when the community was making this investment, solar cost $10 million a megawatt to install. That's when that investment boom started. Now, it costs less than $1 million a megawatt to install, so it dropped 90%. In order for that investment to work, it just presumed that the cost ramp was going to be kind of gradual, and that you could catch up to PV, which at that point was super expensive. It didn't turn out that way, and so as a result, lots of funds got crushed in the process.
That makes sense. Thanks for clarifying that, Tony. That's great. So I'm conscious we've got 3 minutes left. I'd love to get through 2 more questions. So maybe see if we can go through these just with short answers if you've got them. One
Yeah,
from
sure.
Joshua, which was asking, how do you see governments and private companies working together to direct finances into the right place? Often it seems like governments need to kickstart things, or the opposite view might be that the industry drives government thinking in some way. So how can you see those two working together?
Sure. Well, I think the truth of the matter is that we see government and private sector working together a lot around the world. Good example is that we're currently seeing a lot of activity with USAID and United States DFC, which is their emerging market finance arm, looking to partner with us in Latin America around an investment collaborative that we have going on focused on nature-based solutions. And they're looking to provide low-cost capital or specialized capital to fill certain kinds of gaps that the private sector can't fill. And I know that that's not the only example. You look at our own, U.S. Department of Energy. They're putting around, 30 to $40 billion of specialized capital into the market right now just to help address financing gaps up and down the low-carbon transition in the U.S.
Great, thanks. And then the last one is a little bit more kind of personal. If people want to feel like this is the right place for them to work, what any tips or advice, any kind of qualifications or certifications or skills that people might need to work in climate finance, or any other kind of guidance along those lines?
Well, I think there's, the typical answer might be go get an MBA, but I don't think that's necessary at this point. I think that there's a lot of very short certification courses in different parts of the finance problem set that you can take right now that'll help you slot in pretty easily. And then there's a lot of career paths both within. In fact, there's a huge sucking sound for talent right now around climate within the Fortune 500 or the global Fortune 1000 and across all of these financial institutions. Yeah, it's nice to have a MBA or finance training, but I don't think you needed to get into the field at this point.
Great. That sounds like good news for us and for our fellows. So that's great. Thank you so much, Tony. We're out of time. I'm sorry, folks, we didn't get to all the questions, but I hope it's been a valuable session and we've covered lots of ground. So again, thank you so much, Tony, for your time.
Sure.
Take care all.
It was fun. Thanks a lot.